Welcome everyone to today's webinar, Tax Cuts and Jobs Acts for Nonprofits 1 year later. Before I hand it off to our presenters today, I do want to go over a few housekeeping items. You can maximize or minimize the webinar pane during the presentation by using the orange and red arrow buttons. During the webinar, we definitely encourage you to ask questions. In the webinar pane, you'll see a questions box that you can use to type in your question and click submit. Our presenters will be answering those questions throughout the presentation and as well as at the end when time allows. And I also want to make sure everyone has good audio. So if you're using a telephone today, make sure you're selecting the phone call audio option. If you're on your computer, make sure you select the computer audio option. And if you're joining us today for CPE credit, just a few reminders, make sure you're using your own personal computer, no smartphones, and you're logged in using your own unique URL. You have to be logged into our online software for at least 50 consecutive minutes within the scheduled time frame of today's webinar and actively respond to at least 75% of the polling questions. So today we have 4 polling questions, so make sure you answer at least 3. And then we also ask that you complete the evaluation survey at the end of the webinar. And today's learning objectives are to review the impact of the Tax Cuts and Jobs Act on nonprofit organizations, discuss examples specific to parking and transportation benefits for nonprofit employees, and you evaluate next steps for organizations in 2019. And today we have Renee, who has more than 25 years of experience in public accounting and provides audit and consulting services to a broad range of clients in the nonprofit sector. Her expertise extends to income tax matters pertaining to unrelated business income and non-reoccurring business transactions. And we also have Katie, who is an exempt organization specialist with more than 10 years of experience. She works with exempt organizations in a variety of capacities, including consulting on formation, board governance, and ongoing compliance requirements. And with that, I will pass it off to Katie and Renee.
Thank you very much, Marie. So we're really excited to be able to spend some time with you today, Katie, Katie's our real expert on exempt organization taxations. But I know lots of my clients have been asking questions. It's been a year since the law went into effect. There's still some things that people are getting used to. And I think the biggest one is the parking tax issue. I know we're going to spend quite a bit of time on that in this presentation. But there's a few other areas that I think you want to talk about a bit today. So why don't you tell us what we should be aware of and what you're going to cover?
Sure. So the Tax Cuts and Jobs Act, as we know, was kind of rushed into effect at the end of 2017, and it changes several code provisions that affect nonprofits. And there are lots of nonprofits that are now filing tax returns for unrelated business income tax for the first time. Based on new filing requirements for taxable expenditures. We're going to talk about some changes to the Form 990T and how these items get reported and paid on. And then we're going to talk a little bit about the state impact and whether states are conforming to this change or not at this point.
And there's a few other things that you want to cover as well.
Is there? Oh, so we're looking at the total agenda. Sorry about that. So we are looking at the parking and commute benefits tax, which is under section 512A7. And then we're going to also be looking at 512A6, which is the siloing of UBTI activities where they can't offset each other for income and loss purposes, some changes to the net operating loss rules, and then it's kind of things that have a bit more broad application. Excess compensation, there's a tax on excess compensation now, a tax on excess parachute payments, no more advance refunding of tax-exempt bonds, and changes to Section 529 plans, which may be used for K through 12 tuition expenses now.
Great. So why don't we go ahead and dive right into the parking tax situation, and then we'll come back and you can explain some of these other things to us in some more detail. So I think that just laying the groundwork, I don't get this because previously I wasn't aware, honestly, that parking was a qualified fringe benefit. And then when I did become aware of it, I thought that the first $260 were excluded from taxation. So talk to us about that.
Yes, so that is still true. most people were not thinking that parking for an employee, if there was no specific cost for it, was a benefit, really. Usually companies just have a parking lot and you let your employees park there because you want them to show up to work. Now we have to kind of look at it because the I was going to say the IRS, but it's actually Congress. Congress decided that this is no longer a tax-free benefit. So under the old law, the first $260, and it was $260 for 2018, was excluded from taxation if it went to the employee on a pre-tax basis. And if it exceeded that $260 threshold per month, you would have to add that remaining $40 to the employee's taxable income. Under the new law, somebody has to pay tax on it regardless. So it's either the employer or the employee. So now that $260 that is excluded from the employee's income, the employer has to take as a taxable expenditure, or they can remove that benefit from pre-tax treatment if they're allowed to, because there are other regulatory bodies that sometimes say that you can't. For example, in the Bay Area, and I know that there are some places in the LA area also where the Bay Area Air Quality Management District requires you to offer those
transportation benefits. So, Katie, what does that mean? That sounds like the employees are going to end up paying tax on it.
Nope, it's going to be the employer in most cases. So they still can exclude up to $260 per month for 2018, and then it went up to $265 per month for 2019. But anything that the employee doesn't pay tax on, the employer has to pay tax on. And when we're looking at parking, we have to look at what the costs of providing that parking are now also. Originally, it seemed like it was only going to be for parking lots that you were leasing, but now we look at the IRS has given some guidance that says that it's clear they expect us to pay tax on the costs of providing parking in our owned parking lots as well. And then just, to hurt everybody's feelings, you have to pay tax on $20 per month for qualified bicycle commute reimbursements also. So that part I find it's even sadder.
Yeah, so I think there's a lot of outrage about this. It's pretty intense. I mean, as you said earlier, most organizations aren't even filing 990Ts now. They're not subject to income tax, and now we've got a new tax. So how the heck is an organization even going to figure out what its parking expense is? I know I've looked at leases for a lot of my clients, and some of them don't even have extra charges for parking. You mentioned that there was some guidance. Does that guidance help with this at all?
Well, it helps a little bit. It gives a little bit of it points us in a direction, but there is still quite a bit that is not determined, and it really depends on what the parking lot arrangement is. Let's see. Oh, we're at the polling question, so we got to get that done.
So let's find out how many organizations are offering parking. Marie?
Yeah. So the first polling question is, does your organization have employee parking? So no employees, you use public transit or park on the street. Yes, we own our own parking lot areas. Yes, we lease parking spaces for some or all of our employees. Or the last option, yes, we have some owned and some leased parking. So go ahead and let us know what your parking structure looks like. Give everyone just a few seconds here. Okay, we're about 80% voted in, so we'll go ahead and close the polls and see what everyone voted.
Wow, so
pretty good mix.
Yeah, it looks like almost everybody is providing parking. Only 17% don't, and some of those we didn't ask whether or not there's public transportation benefits. So it looks like this is really going to be applicable to most of our organizations.
Mm-hmm. Yes. So in December of 2018, we received Notice 2018-99, which gave us some guidance on how the IRS expected us to calculate this parking tax. And basically, in terms of scope, it applies to any parking provided to employees at work. So that includes parking lots that are owned by the employer, parking that's included in the lease and not separately stated, leased parking lots and spaces, and it began on January 1st, 2018. And it doesn't really matter what your tax year is. That is the hard start date for when these amounts became taxable. So if you had a fiscal year, we've been looking at just the amounts that started after January 1st, 2018. And in the guidance, it did give us some general principles that we might not have necessarily thought of. So they told us that we do have to focus on normal business hours, and we're not looking at 24 hours per day because most employee parking lots are not in use overnight unless you are open 24/7, which is not the case for a lot of our nonprofits. So we have to be looking at normal business hours. But they did say that if the spots are typically empty, that those do not count as employee spots. And they've also said that we can remove any signage or barriers by March 31st, 2019. So that's the end of this month. And they would treat it as retroactive back to January 1st, 2018. So if you remove signage or barriers before the end of this month, you can avoid having specifically allocated employee parking spots. So there's a little bit of time left to change that.
Interesting. So that might not be so easy to affect, but in some situations it could be. It could be just a matter of removing a sign or, eliminating some markings on some spaces. But just to clarify, so this is only right when the employer is paying or providing the parking. If I, as an employee, am not provided parking, but sometimes choose myself to pay to park in my employer's office building lot, for example, or if I am paying for metered parking personally, this doesn't apply in that situation. Is that right?
Right. As long as that is after tax dollars, if that is your own personal expense as an employee, then that's perfectly fine. But if the employer is providing anything to you on a pre-tax basis, which you might not have thought they were providing you something special or some sort of tax benefit, because everybody has to park at work if they drive there. It is considered a benefit, unfortunately.
Okay, so this is interesting. It seems to apply to every employer providing parking. You mentioned that there was an IRS notice. Did they provide any more guidance on how to calculate what costs to pay the tax on?
Yes. So there's two steps that you really, two things you have to consider. And they gave us a 4-step process that we could use. They basically said you can use any reasonable method, and they said if you use their 4-step process, it would be considered a reasonable method, but this is not the only method that you could use. So it kind of points us in a direction and says they will definitely treat this as a reasonable method, but if you have something else you want to do, then you can try that. But this is their 4-step process. So first, they want you to look at how much parking is reserved specifically for employees, and that amount is going to be taxable. So the costs for the amount that are set aside specifically for employees, either with signage or some sort of physical barrier where it says employee only parking, or maybe you need a pass to open a gate. If that is behind some sort of barrier or signage, that part's going to be taxable. So first, we look at the amount of the parking that is being used reserved for employee only. Step 2 is then to look at the primary use of the remaining area that is unmarked. Is it primarily used by employees or by non-employees? So they say that if we have 50% or more actually used by non-employees, then we can leave the entire area, we can treat it as non-taxable. So that is a great case, if you have a lot of public parking where employees are mixed in with the public. Let's say you have 200 spots, you only have 50 employees, for sure then that you've got less than 50% actual usage by employees, and we can ignore that parking area for tax purposes, which is great. If we find that more than half is actually used by employees, then we have to allocate between employee and non-employee use based on any reasonable method. So again, there are a couple of things that they said you could use, either number of spots or number of employees. So again, if I said we had 100 parking spaces and I've got 80 employees, I know that they're mostly using that parking more than 50% for employees. So then we could look at the number of spots, number of employee, hours of use, whatever it is that is reasonable. If you have part-time employees, maybe they're only there for a few hours. You would have to look at your specific situation. Unfortunately, they didn't lay out, everything for us. The main thing that we need to worry about for that is documentation. So we just have to be able to support the position that we're taking. Anything that's reasonable will be accepted, though. Then in step 3, there's so many steps. Step 3, we calculate the exclusion for reserved non-employee parking. So if you've got handicap designated spaces, or you've got customer only parking, or if there's an area that the employees are not allowed to park in, then that amount is going to be non-taxable as well. That is clearly non-taxable. And then in step 4, we determine the remaining use and allocable expenses. So we would look at what are the actual costs to maintain this parking lot. And that's the amount that we're going to be applying to either employee or non-employee usage.
Okay, so we're getting a lot of questions coming in with some specific situations, and I think we've got a few examples prepared, right? So why don't we go through those, and then if we have time at the end, we can try to respond to some of these specific questions in different scenarios, and perhaps our examples will answer some of them. And for those people who are listening, participating in the webinar, I want to let you know that we'll certainly respond to you if we run out of time to respond to every question on the webinar itself. We'll follow up afterwards. But why don't we go ahead and start with the first example that we have prepared on how to apply this process.
Sure. All right, so here's our first one. We're looking at a lease with no specific rate stated for parking. So we have a museum, they are leasing their space, their building, and it includes parking. And here's the specific situation. So it's got 500 spots in the lot, 50 are reserved for management, and there are about 100 employees that park in non-reserved spots. And then when we're looking at expenses, we have $20,000 in a common area maintenance fee, which is allocated to the organization each year. And we estimate that about half of that is related to the parking lot. So, we're looking at what all does the CAM cover? Is it, internal lobby space or external landscaping? And you can use any reasonable method to determine, again, what we estimate. So we went with about 50% to parking based on this specific situation. So in our first step, we're looking at what are the reserve spots, because we've got 50 that are reserved for management. So we know that those are going to be taxable, and that's 50 out of 500. So in that case, we're taking the 10,000 that is allocated to the parking lot and multiplying it by 1/10. So we get $1,000 of cost related to those reserved spots. And then when we look at the primary use of the other spaces, there are 350 spots that are not used by employees out of 450. So we've got 78% non-employee use. So we don't need to worry about those other spots that are not reserved for management. And then as the example shows, we don't need to do any of the other steps. And if they didn't have any other unrelated business income items, they would file the 990T because the filing threshold is $1,000. But there is a $1,000 specific deduction on the 990T, and it would bring them back down to zero, so they would not owe any tax. So if you have $2,000 of UBTI, you get $1,000 specific deduction, and you'd only have $1,000 of taxable income. So in this case, they would file, but they would not actually end up having to pay. And the point we want to make here is when there's no employee reserve parking and the non-employee use is more than half, the entire cost is not taxable.
So that's a great point. And I also just want to clarify what's been used as the cost here.
Yes.
That the scenario describes says that there's no specific rate for parking, but the organization does have to pay common area maintenance fees. So does that seem like a situation that would be common, and does it make sense that if there is no parking called out in the lease, that there still might need to be an expense allocated to parking?
Yes, so that is a really good point too. Just because it doesn't specifically say how much is for parking or for maintaining the parking areas, we have to really, they expect us to look and see what are the actual costs of maintaining it. In this case, having a common area maintenance fee is pretty easy because we know that it's being used for those common areas and we can kind of allocate it out. I think that's an easy way to look at total expenses that might be allocable to parking. If you don't have a common area maintenance fee, then you might just be looking at, costs for the people who work in the parking lot. How often is it cleaned? How often does the trash get taken out? But we want to be aggressive in allocating away from the parking lot to the extent possible because we don't want people to pay tax that they don't need to pay. So as long as it's reasonable, it doesn't have to be, you don't have to punish yourself overly. We can allocate away as much as possible.
Great. So let's go through another example.
Right.
In this one, it's a social service organization. It leases, and the organization has 10 reserved spots, of which 8 are used by employees and 2 are reserved for visitors. And then the lease also allows for access to another 90 spaces per day, but it's in a parking lot that visitors have to pay to enter. So anybody who pays, I suppose it's possible an employee might use it. It's similar to the last example, there's $20,000 in CAM allocated with estimated $10,000 related to parking, but the situation is different. So can you walk us through this one?
Yes. Also interesting is that it's open to the public on nights and weekends, and the public also pays. So in this case, we know that we've got 8 reserve spots at $100 a month. That are definitely reserved for employees. So we know that portion is going to be taxable. So we look at that times 12 for the entire year of 2018, and we get to a yearly cost of $9,600 for those 8 spots.
And that's step 1, right, Katie?
Yes.
Looking at the things that are just set aside for employees.
Right. And then the others, because they are paid, and whether it's visitors or employees, anybody who's actually paying for the parking on an after-tax basis, we know we don't have to pay tax on. So we can ignore all the rest of those, and all we have to look at is the 8 that are reserved for employees. So we're looking there at that yearly cost of $9,600, and then we are subtracting out the $1,000 specific deduction and getting to $8,600 taxable at a 21% tax rate means there's a tax due of $1,806. So because the CAM information there, we know that covers the parking lot, but we also know that we're spending specific amounts for the ones that are reserved for employees, and the common area maintenance is going to all those areas that could be used by visitors or paying employees. So we don't have to worry about the common area maintenance fee in this case. We're only looking at the $100 per month for those 8 reserved employee spots. So they do have to file the 990T because they've got $8,600 in taxable expenditures. And if there are no other activities, then they would have that $1,806 in tax.
Okay, great. Thank you. Why don't we go through one more example and then we'll head into another polling question.
Great.
So this one, an organization, in this case it's a health clinic, and they're leasing a full building that comes with a parking lot. There's no reserved spots for the employees at all. There's a total of 200 spots in the lot, and they estimate that they have about 120 employees parking each day. There are 10 reserved spots. They're accessible spots, and none of the employees use those. The organization does have to pay for any of the costs. It's a triple net lease, so they're paying everything. And they've estimated that the cost related to the parking is about $15,000 annually. So how would they calculate their tax on this situation?
All right, so we know that we've got 200 total spaces, and there are 10 that are reserved for non-employees, so we can pull those out of the total calculation. So we know that there are only 190 that could potentially be taxable depending on the usage of them. Is it generally employee or is it generally non-employee? So we think that we have about 120 who park there as employees, and so that gets us to 63% being taxable. So we're assuming that the remaining 70 are there for visitors and other people who are not employees. So then we're using a 63.2% of the potentially taxable spots are going to be treated as taxable because of employee use. And we multiply that times the actual yearly cost and subtract out the portion that is reserved for non-employees. So those are those 10 spots. So the $750 relates to the 10 parking places that are accessible. We get to $14,250 that is the cost of the 63% that is taxable. And then in multiplying that out, so you can see that's the 63.2% times 14,250, we get to $9,000, which was just a very happy accident that it was such a round number. So we would expect to see $9,000 in costs allocable to the employees, subtract out the specific deduction of $1,000, and we're at $8,000 in taxable expenses. At 21% tax rate, that's $1,680 in tax. So they would file a 990T in this case, report the $9,000, and pay over the tax of $1,680.
Okay, and so just to kind of go back to the IRS process, they didn't really need to do step one in this case because there was no reserved employee parking.
Right.
In step two, they determined that the primary use was actually employee parking, and we actually did step two as step three in our calculation, basically. And then they were able to exclude 5% of the total cost because there were spots reserved that could not be used by employees. So, okay, great. Well, let's jump in and do our next polling question, and then we'll come back with some more examples.
Great.
Perfect. So our next polling question is, has your organization already begun analyzing whether the Tax Cuts and Jobs Act will impact you? So yes, we expect to have new filings this year. Yes, but we haven't finalized our position. No, we still need to discuss internally. Or the last option, I don't know or not applicable. So go ahead and get your answers in. Just a reminder, there are 4 polling questions total. And if you're here for CPE credit, make sure you answer at least 3 of them. Okay, so we have about 90% in, so we'll go ahead and close the polls. Okay.
All right, good. Well, it looks like we have a lot of people who are still trying to figure this out, and hopefully by the end of this hour, they'll be a little bit more informed, but again, we're certainly standing by and available to advise on specific situations. I think now we're going to look a little bit at some more things that could be occurring. I mean, the office leases do treat parking in all kinds of different ways. We've already talked a little bit about if the lease doesn't specify a cost of parking, and you've said that it probably isn't safe to assume that there's no parking costs. What about like the fair value of parking? I mean, we haven't discussed that. Is that something that should be considered?
Interestingly, that notice 2018-99 said specifically that fair value is not a reasonable method of determining cost. So, you know, it would make sense that if you were looking at, you know, what are the, if I know that parking spaces in lots around my area cost $200 a month and I've got 10, I could reasonably assume that they would be $200 a month apiece. But what they're actually taxing us on is not fair value, but cost. So in a lot of cases, that means that it's going to be lower than the actual fair value, because it's maybe included as part of, their incentives in the lease, or they want to have the space utilized. And I've seen calculations where we've actually assigned a lower value to certain parking spaces in the same, or a certain cost, lower cost for parking spaces in the same structure based on how we're figuring out what the costs are. So, some of them are included in a lease, and maybe there's extra for additional that are being paid directly. When it is a clearly stated lease amount, that's usually the easiest. If I know I'm paying $15,000 a year for a lease on this entire parking lot, my costs are easy to calculate. But when it's included with other things, we have to look at what are the actual costs allocable. So not fair value.
So that's why you used CAM in those earlier examples.
Yes.
And certainly, as you pointed out, if you're paying directly to a third-party parking company, or the lease specifies a per month rate, that's the cost, right? Even if perhaps the landlord's actual cost was lower, your cost is that stated rate.
Mm-hmm.
But there could be leases too that don't have CAM or a specific charge.
Very true.
Again, it sounds like everything's in scope. So I think we have one last example of how to figure out what costs might be when it's not specifically laid out.
Yes.
So we'll head back into some of those other questions after we go through this one.
Okay, great. So here's one where the developer is leasing an office space that comes with parking. So there are 6 parking spots included in the lease, and all are used by employees. There's no specific rate set for the parking and no CAM. We know that their total office lease is $10,000 per month. And there are 500 spots in the parking lot, of which 200 are reserved for the various tenants and are believed to be used by the tenants' employees. There are 2 parking lot attendants, because it's one of those really cool stacked parking lots and the cars have to be moved. And so you've got 2 people whose full-time job is to just move cars in and out. And then we know that they clean the lot once a month. So in looking at this example, we know over on the right-hand side there, we've got 500 spaces in the lot, and the amount that are reserved for all tenants' employees are 180. Well, we had said 200, but same difference. You get the idea. There's 36% then that are reserved for employees. The number of spots that the organization has, we know, is 6, and percentage of all employee use, which is 6 divided by 180, gets us to 3.3%. So we're looking at a large parking lot, and we've determined that our 6 employee spots represent 3.3% of the employee parking generally. Now we're going to look at costs. So we don't really know what the people are being paid because it's handled by the management, but we're going to assume that we've got 2 people at $15 an hour, which is, we think a reasonable estimation. If that's not minimum wage in your area, it's probably going to be soon. And then times 22 days a month, that's the average working days in a month. So we're going to estimate that their salary cost is $5,280. Then the monthly cleaning, we're going to estimate $400, and estimated repairs, we're estimating $100. So again, that's maybe $1,200 a month in just upkeep and maintenance, $400 a month for cleaning, and then we are estimating, and again, these numbers are just estimates. These are things that we are assuming and that we're, doing our best guess at. So the total cost, yes, go ahead.
Yeah, so the total cost estimated for the landlord is pretty big, but the total amount that's being allocated to our organization here is only $832 per year.
Right.
That's awesome. I assume that means that they do not need to file the 990T in that situation.
That's right, because you have to have at least $1,000 to have a filing requirement. So 832 means that they would not have to file. We would just keep this calculation in our tax documents and make sure that if the IRS were ever to come asking, we could show them how we calculated it.
Great. So let's go back and look at our recommendations on documentation requirements. So again, you reiterated that any reasonable method is allowable. I assume you think this little thought experiment we just went through would be considered reasonable.
Yeah, I think it's fair to estimate, a median wage on those people. And when you're looking at actually cleaning a parking lot, there's not a lot there. You might have leaf blowing or sweeping or something like that once a month. And since we have no way of knowing, all we can do is make a reasonable estimate. So the IRS has specifically said that their guidance in 2018-99 will be considered reasonable, but is not the only reasonable method. So as long as we're documenting exactly how our costs were allocated, and we want to keep track of what areas and items that are next to, if you've got landscaping that goes around a parking lot, that doesn't have to be included in the parking lot. You only have to, I would say if you've got trees in the center of the parking lot, then maybe you have some landscaping costs. But if it's, there's trees all the way around and it's not actually in the parking lot, then we don't need to account for that landscaping cost. So again, there's no, no prize for suffering extra and paying more. So we want to allocate everything away that we reasonably can. And then we do recommend that you maintain those records for the length of the statute of limitations, which is for federal 3 years from the date of filing or the original due date, whichever is earlier.
Okay, and for an organization that does need to try to either add up costs because they are paying them directly or estimate costs that their landlord is paying, what sorts of things need to be included?
So the notice did say that there were specific costs that we do have to take into account, and that's going to be utilities, insurance and interest, maintenance and repair, leaf, trash, or snow removal, parking lot attendants or valet personnel, security, property taxes, which is a really tough one for me because I don't like paying tax on the tax. It just seems to be against general taxation principles, but they did specifically say that that is a cost we have to look at. And then rent or lease payments for the parking spaces or the parking lot, but not depreciation. So capital improvements and things like that do not get counted in. And it'll only be like lease payments and then the actual cost of maintaining.
Okay, what about one thing that's not on this list but is maybe similar in concept? What if an organization doesn't actually provide the parking but gives a pre-tax deduction to employees so that they can pay for parking?
And then we would have to look at the amount that the employees are setting aside on a pre-tax basis and pay tax on that. So somebody's got to pay tax on it, either the employee or the employer.
All right.
And that is true also for like commute passes also.
Okay.
So we've been talking a lot about parking, but this also does apply to pre-tax commute benefits such as Clipper cards or bus passes or things like that the employees are allowed to set aside pre-tax money for themselves. The employer then would have to go back to their payroll provider and find out what's the total amount that the employees set aside, and then they have to report and pay tax on that. So that is, even though it is coming from employee income, because it's being taken on a pre-tax basis, we have to pay tax on it ourselves as the employer.
And are we allowed to take deductions since this is being treated as unrelated business income?
We had hoped so, but it looks like no. The way that the form and the instructions ended up being written does not give a place for us to take deductions against this amount. And it just says, whatever your total costs are, throw it on this line and it's taxable. So this is a problem, I think, because it is the reason that they enacted this on nonprofit employers was because these same expenses are now non-deductible to for-profit employers. So they wanted to put nonprofit employers on the same tax footing as a for-profit employer. what's really not fair about that is that there's no way for us to deduct the costs for the additional filings, your staff time and energy listening to this webinar and calculating your costs. All of that is stuff that a for-profit business would be able to deduct, but that nonprofits are not being allowed to get the benefit of. So I see this as a big difference between the way that nonprofits and for-profit employers are being treated under the tax law. And I definitely suggest providing comment to the IRS on this. I sent in a letter to the IRS myself about it. And you can also write or call your Congress people, because there is some effort in Congress to repeal this on nonprofits at least. But nothing has happened yet.
Yeah, I think we have a little bit of update later.
Oh,
okay, so assuming that you have to file this, what do you do?
So the tax rates, oddly enough, are going to be blended if you had a fiscal year that started in 2017. So even though the tax did not come into effect until January 1st, 2018, and we only have to count expenses that occurred after that point, you're still going to get the benefit of a blended rate. So you'll have the old tiered rates on half of it. If you had, let's say a June 30, 2018 year end, you would end up with a blended rate. If you've got a full 2018 tax year and then anytime later, you're going to have a flat 21% tax rate if you're a corporation. Some nonprofits are organized as trusts, but that's pretty unusual in our client group anyway. So for corporations, it's 21%. Trusts are still taxed at regular graduated rates from before, so there's not a huge change in the trust rates. They did give us some automatic relief from underpayment penalties for first-time filers. So if you've never had to file a 990T before, and then this tax came into effect, they did realize that they provided the guidance after the initial due date for a lot of companies. So they did offer automatic relief from underpayment penalties, not for late filing or anything like that, but for underpayment only. And that came out in Notice 2018-100. And then we had a question there too that I think is important. If we do have a couple of clients who said that they think this is going to be overturned and they vehemently do not want to file and pay tax on this amount. We're documenting that position and keeping it on file. It is your filing and we're not going to turn you in or anything. So in all of the cases that we've been looking at, in terms of impact on audit, the amount is immaterial. So if it looks like it would be a huge number and it's going to be a problem for audit, then we would talk to you about it. But if it's a smaller number and you're saying, no, we're just not going to do it, we will document that and we don't expect it to have an impact on the audit.
Okay, and the reporting, we've already talked about it being on the 990T and that there's a $1,000 specific deduction. How do you make payments?
So anytime that you have to make a payment of $500 or more, they require you to set up an account on EFTPS, which is the electronic transfer and payment system for the government. The website is www.eftps.gov. And it's an online system. You go in and set up your account, and then they'll send you a PIN in the mail that comes approximately 10 business days after you start that initial online sign-up process. So you have to do it in advance in order to make your payments on time. They will be able to schedule it over the phone for you 48 hours after you sign up online, but if you want to be able to do it just setting it up with a bank account and doing the entire thing online, it'll take about 10 days. And then you're also required to make quarterly estimate payments if the total amount that is going to be due is over $1,000. So that means that for a calendar year nonprofit, you would have quarterly estimate payments due on May 15th, June 16th, June 15th, September 15th, and December 15th. So you have to divide it into quarterly payments and make estimates. You can always pay early, but don't pay late. That's the general rule there for the IRS.
Okay, and what about states? Whoops.
So California has not conformed to any of the Tax Cuts and Jobs Act changes yet. Some states have an automatic conformity law that automatically changes their state tax law to conform to federal changes. Some states have decoupled from federal conformity. So New York is one of the automatic conformity states, but they've specifically decoupled from this on the parking tax. So California, again, has not conformed, and so there is no parking tax and no change to Form 109 filing requirements. So we have several clients that are only filing a 990T and not filing a California 109 because they only have these parking taxes. One other thing to note is that California has not conformed to the changes to 529 plans either, and so there's still a 3% penalty for taking money out for K through 12 tuition. I'll talk about that a little bit more in just a moment. And then, for example, in Texas, there's no tax on unrelated business income at all, so they don't have to worry about any kind of conformity to this sort of thing. So it really depends on the state.
Okay, great. And then for those of you who are wondering, will this go away? Last Thursday's Nonprofit Times had an article on the latest repeal effort. So, you indicated earlier that people might want to contact their representatives. But as of now, it is the law, and May 15th is the filing deadline for 12/31/18 clients not extended, and for June 30, 18, that's the final deadline for that 990T. So it is something that needs to be considered unless somehow it gets overturned before May 15th. We've got just about 15 minutes left, and we've got another we've got a number of questions, that have been coming in. And so I don't know that we're going to be able to get to all of them, but these FAQs that you put together, Katie, I think some of them that you've addressed, but some of them have not. If you want to emphasize a few of these before we head into the last polling question and last segment.
Okay, yeah. Let's see.
One question, though, that we got that I think might be important is if there is no charge for parking in the area that the organization exists, but there is a special lot, for example, a school out in the suburbs, and there's just no parking charged by anybody anywhere, is this still going to apply?
Unfortunately, yes. Even if there's no, and again, that's where the fair market value versus cost issue comes up. So you could argue that the fair market value is 0, but if you've got costs to maintain it, which, maybe they're very minimal and maybe you don't have a filing requirement, but we do have to look at it, and that type of parking would be subject to the rule, yes.
Yeah, that's what I figured you would say based on the cost versus value discussion earlier. So I think one of the more important questions on here is, what if you've already filed a 990T in November? Should you be amending it? This is for a fiscal year entity.
Yes, so we did have several clients who filed ahead of November 15th, so they wouldn't have to go on extension. And then this guidance came out in December saying that owned parking lots were still an issue. So it is up to you whether you want to amend and pay additional based on these updated facts. I think the most important thing is going to be to get it right going forward. So, it is up to each individual organization, depending on your risk tolerance, how much you want to deal with. We do have one client that, for example, found out they also had a K1 this year for the first time. And so we had to go back and amend to add that in, that additional unrelated business income tax. So we did end up amending to correct and add in the costs for the owned parking lots. But then I've got other clients who I know are just going to be fixing it next year and adding it in. So it is, we're happy to talk to you about what you want to do, but it is up to each individual organization.
Okay, great. So in the interest of time, why don't we go to the next polling question, and then we will spend a little time discussing UBTI, and hopefully have a little more time later for more questions.
Great.
So does your organization currently have any unrelated business activities? So yes, minimal sales of unrelated goods. Yes, we operate a full line of business that's unrelated. Yes, we have debt financed rental income. Yes, we have some other type of unrelated business income, or no. So go ahead and get your vote in. And also as a reminder, you'll receive an email from us within the next 48 hours that will have a link to today's recording of the webinar, as well as a link to be able to download the presentation. So we'll give everyone just a few more seconds here to get their vote in. Okay, and we'll go ahead and close the polls.
So it looks like, again, I'm not surprised that about 62% of the people who responded don't have any unrelated business activity outside of this whole parking situation. So this is going to be new for a lot of organizations. And hopefully many of you, once you do the calculation, will find that you don't have a filing requirement. To reiterate on that, because a couple of questions have come through. However you do this calculation, if you come up with less than $1,000 as the potentially taxable amount, then you are not going to have to file. Okay, so let's, because this is related to other unrelated business income issues, Katie, why don't you talk about this new development with UBTI revenue streams?
Yes, so in section 512A6, and this is also from the Tax Cuts and Jobs Act, this is a new provision that says the income and losses from different UBTI activities cannot offset each other, including for net operating loss purposes. So this is effective for tax years 2018 and later, so any tax year that begins after December 31st, 2017. And they did issue a notice a little bit earlier, notice 2018-67, which kind of gives some guidance on how we are supposed to divide these up, because you might have, let's say you've got a partnership K1 that has one type of UBTI, or you don't even know necessarily what they're doing, they're just passing it through to you. It can be tricky to know how you're supposed to group these activities. So in the notice, they suggested using the NAICS codes, or maybe the first 3 digits. So those are those 6-digit business codes that the IRS uses to classify businesses for tax purposes, and that is out there publicly. So they are trying to find a reasonable method. They asked for comment on whether the first 3 digits would be good enough, or if people had any other suggestions. So they're still trying to figure out exactly how to do it, but it did say that we are allowed to group all partnership pass-through UBTI into one activity. So that's all passive investments can be treated as one trade or business for a nonprofit organization. And to qualify for that, you have to have less than 2% ownership. That would be considered de minimis, or you have to have a lack of control. So that would be 20% or less ownership and no actual control. So if you're actively operating a business, that's going to be its own revenue stream, even if you're in a partnership or something like that. If it's a passive investment partnership where you're not actually controlling anything, or you've got de minimis ownership, you're allowed to group all of those together. So that is much more helpful than trying to figure out what each of these partnerships is actually doing and trying to separate them. So that is a nice kind of nice thing that we found out. But what that means then is that if you've got other activity, so let's say you've got income from a rental activity and loss from a partnership activity, you will still have to pay tax on that income item, because you're not allowed to use net operating losses or losses in the current year from the other activity to offset it, which currently you can. Currently it all nets together and generates a regular net operating loss that applies to all activities. For 2018 and later, we're going to have to keep them separate.
So what are some types of things that might generate UBTI?
There are several types of activities. Some of the most common ones that we see are advertising. So if you're selling advertising in your publications or on your website, in many cases that is unrelated business income. We see pass-through UBTI on investment partnership K1s. We see rental of debt financed property. So if you have a building that you've got debt on and you're renting out any portion of it to a third party, that is generally unrelated business income tax. And there is an exception for schools of that rule, but schools get caught on the other side with private business use of tax exempt bond financed property, which oftentimes schools have. So any private business use where you're letting another person conduct a business activity in your bond finance facility is per se UBTI. Also rental of facilities that include significant services. So if you've got event planning personnel or you have additional security, set up, tear down, that type of service, that's going to be taxable. And then rental of property other than real estate, which is personal property for tax purposes. So if you're renting items, furniture, musical instruments, costumes, things like that, all of that is taxable as well. So things to look out for if you don't, if you're not sure. And again, feel free to reach out to us with any questions on any of these.
And then I think you kind of went over some of this already, but if there's anything you want to emphasize on these NOL rules.
So the new 512A6 rule that requires us to silo unrelated business income activities, it applies for net operating losses as well. So Section 172A now limits net operating loss carryovers to 80% of taxable income, and the NOLs generated in one UBTI activity will only be applicable to that activity, and it is subject to the 80% limitation. So if I had a rental activity that had a loss last year and I'm carrying it forward, I can only use that loss against future income from that same activity up to 80% of taxable income per year. So I'm going to have to pay tax on at least a portion of it, no matter what. And then Section 172B eliminates the 2-year carryback provision. So all NOLs are going to carry forward only for 20 years. And this is effective for tax years beginning after December 31st, 2017. So anything that was a 2017 or prior net operating loss can still apply 100% to any business activity. So it's only these later ones that are going to be limited to the activity that generated them.
Okay, interesting. And is there
there's ordering.
Yeah.
So in later years, in 2018 and later, we use the specific NOLs first, subject to the 80% limitation, and then we can use our 2017 all-purpose NOLs after that. So that is kind of a nice thing too. You use up the ones that are more limited first, and your more valuable 2017 and earlier net operating losses don't get used up first, and they can apply again 20 years forward. So you might be able to use them for quite some time. And the 2017 and prior NOLs can be used against any activity, including the parking and commute tax. So those are really valuable NOLs.
Okay, great. So there is some offsetting possibility. So Katie, we're getting a ton of questions still on the parking, and some of them we haven't covered. Would you like to set aside these the excess compensation and spend a little bit more time on the parking? So let's do that. And then Marie, why don't you go ahead and we can do the last polling question, and then we can stay on as long as people are willing to answer some of the questions that came in on the parking.
Perfect. Okay, we'll go ahead and launch the last polling question. So the last question is, how did the change in the tax law impact year-end giving at your organization? So was there no change? Was there an increase in year-end gifts, or was there a decrease in year-end gifts? Go ahead and let us know what that looked like.
Oh, I'm very interested to hear what people have to say about this. We haven't talked in this session at all about the impact of this law on individuals, but it was certainly more extensive even than how it's impacting not-for-profits.
Yeah. Okay, awesome. We're getting a lot of people answering this question. We'll give everyone about 3 more seconds here, and then we'll go ahead and close the polls.
Well, that's better news than I expected. Yeah, Katie, I don't know if you want to just comment on this real quick and what your expectations were.
I'm not terribly surprised that it seems like there's not a huge amount of change. I mean, I think we did expect to see some decrease, but overall, it seems like most people are not necessarily giving for tax purposes, but because they support the organizations, and so the change to the tax law didn't affect a lot of giving. But I think we'll know even more after next year when we've got a little bit more time, when people have filed their 2018 tax returns and seen how it went. I think probably even later this year, we'll know a little bit more too.
Good, good. Well, I'm glad there was not, it doesn't seem like there was a wholesale mass reduction of contributions. So let's go back to a couple of these parking questions. One that came in that I don't think we've responded to yet is what you do if you have more than one facility. That 50% threshold on employee use, does that have to be calculated separately for each place that parking is provided?
I believe if it is in the same vicinity and the same building, or if it's like one campus, you can combine it all together. But if they're in completely different locations, I don't think that we can group them together.
Okay, so I mean that makes sense. We already talked again about, well, what if there's no actual value? Let's see, there was a question about submitting payment electronically. What if you don't do that? And again, I think for 60% of the people on this call, if they have to file, it's going to be a first time. So how does that penalty work again?
I haven't seen any penalty notices coming. So we did have some clients in November who had to pay with a check because they just didn't have time. I kept asking the IRS, is there any other method, can we send a check? They have not turned down any checks, and I believe they're still cashing checks. And I have not seen any, I haven't seen any penalty notices for that, but they will probably send you a letter saying, we received your payment and now you're required to file or, pay on EFTPS, and here's how you get there. So they do really pressure you to do it that way, although they do, of course, cash your check. So,
so the first time you're probably okay paying by check, but if it's going to be ongoing, you do need to set it up. I think it's easier too.
It is, and you have to be aware when you set it up on EFTPS, you have to set it up at least a day in advance. So if you go in on the deadline and expect to pay, it's not going to clear till the next day, and you'll be late. So you want to be sure that you're getting ahead of it and giving yourself plenty of time to get it scheduled.
Okay. There was one more scenario that came in as a question that I thought was something that could come up with other clients where an organization is sharing parking in a facility with the county, and there's kind of public access to the spaces, and there's no specific set aside for the employees of the nonprofit. How would they approach that?
So I would look at the total number of spaces in the parking lot and your total number of employees. And since there's no way to really divide it out, if it's a 500 parking lot space and you've only got 100 employees, there's no way that your employee parking can represent more than half. And you've done your best effort to determine, I don't think you need to worry about it beyond that.
Okay, great. Well, I think there's some other ones, but some of those questions are fairly specific, so I think we can try and respond to those individually, and we are definitely over our time now. So Marie, do you want to wrap us up and tell people how to get their CPE credit and download these slides?
No, definitely. So you'll receive an email within the next 48 hours that will have a link to today's recording of the webinar, as well as a link to be able to download the presentation. And then you'll receive a message from our L&D team within the next 48 hours if you're here for CPE to receive your certificate. So everything will get sent within the next 2 days.
Great, thank you. And thank you, Katie, for going through this, and we wish everyone luck in navigating this parking tax.
Yes, yes, thank you. And thanks everybody for attending.